Good day, everyone, and welcome back to the show. Today we are tearing up the script. If you've been following the Australian financial headlines, you know that the super wars have been raging for the better part of 2 years. For a long time, we've been operating under this dark cloud of uncertainty regarding the proposed Division 296 tax, the controversial plan to tax superannuation balances over $3 million. It was the talk of every barbecue, every boardroom, and certainly every accountant's office from Perth to Sydney. The original proposal was, to put it mildly, a radical departure from how we understand taxation. It proposed taxing money you hadn't even made yet, unrealized gains. Well, grab a coffee because everything just changed. On October 13th, the Treasurer stepped up to the podium and dropped a bombshell that has completely rewritten the rulebook. It's a massive U-turn, a strategic retreat, and a whole new landscape for investors all rolled into one. Today, we're going to do a deep dive, a forensic analysis of what this great reversal actually means. We're going to walk through the 6 specific reforms that have replaced the old proposal. We're going to talk about the winners, the losers, and the constitutional loopholes for judges. But most importantly, we're going to talk about strategy. Because if you're a property investor or if you run a self-managed super fund, the green light just flickered on for a very specific type of investment. So buckle up. Let's get into the nitty-gritty of the new super tax regime. First, let's set the scene. Why is this such a big deal? Back in February 2023, the government floated this idea. If you have more than $3 million in super, we're going to tax the earnings on the excess at a higher rate. Fair enough, some said, but the devil was in the detail. They wanted to tax unrealized capital gains. Imagine you own a farm or a commercial property inside your super fund. Its value goes up on paper by $1 million because the market is hot. You haven't sold it. You haven't seen a cent of cash. But under the old plan, the taxman would have knocked on your door, demanding a cut of that paper profit. It was a liquidity nightmare waiting to happen. It terrified farmers, business owners, and real estate investors. It was the single most contentious point of the whole debate. Now, fast forward to October 13th. The Treasurer, facing immense pressure from essentially every sector of the economy, blinked. The first and biggest reform, the death of the paper tax. This is reform number 1, and it is the headline act. The government has officially scrapped the plan to tax unrealized capital gains. Let me repeat that because it is the news we've all been waiting for. You will not be taxed on paper profits. They are reverting to the standard, same method of taxation. You only pay tax when you actually sell the asset and realize the gain. Why does this matter? It restores sanity to the system. It means you don't have to panic sell a property just to pay a tax bill on a value jump that might disappear next year. For high net worth individuals and property investors, this is the victory. The liquidity crisis is canceled. Reform number 2, the new tiered tax structure. But the government still wants their slice of the pie. They aren't walking away empty-handed. Instead of the complex formula they proposed earlier, they are introducing a cleaner, albeit steeper, tiered tax structure. Here is how it breaks down. Currently, earnings in super are generally taxed at a concessional rate of 15%. Under the new plan, we have a 3-tier system, up to $3 million, business as usual. You keep your sweet 15% tax rate, $3 million to $10 million. This is the new Tier 2. Earnings on balances in this bracket will now be taxed at 30%. That's double the current rate, but still generally lower than the top marginal personal tax rate. Over $10 million, this is where the hammer falls. If you're in the ultra-wealthy category with over $10 million in super, your earnings on that excess will be taxed at 40%. It's a progressive tax system, similar to income tax, but applied to your retirement savings. It's designed to target the mega-rich while leaving the comfortable rich with a slightly higher bill. Reform number 3, indexation is here. Now, one of the biggest criticisms of the original $3 million cap was that it wasn't indexed. In 20 years, with inflation, $3 million won't buy what it buys today. It's the classic bracket creep, dragging regular middle-class Australians into a tax net designed for the wealthy. The government listened. In reform number 3, They announced that both the $3 million and the new $10 million thresholds will be indexed to inflation. This is crucial for intergenerational planning. The $3 million cap will increase in increments of $150,000, which means a 5% jump, and the $10 million cap will rise in chunks of $500,000. This ensures that the tax targets the wealthy relative to the economy, not just anyone who held an asset for 30 years. Reform number 4, the delay. If you're sitting there sweating about your current portfolio, take a breath. Reform number 4 is a timeline shift. The implementation date has been pushed back by a full year. Originally slated for July 1st, 2025, the start date is now July 1st, 2026. Why the delay? 2 reasons. 1, the industry needs time to adjust. Accounting software needs to be updated. Strategies need to be rewritten. 2, the Treasury is opening another round of consultation, which we'll touch on in a moment. This gives us a massive window of opportunity, a grace period, if you will, to get our houses in order. Reform number 5, the sweetener. Politics is all about the carrot and the stick. We've talked about the stick, which indicates the higher taxes. Now here's the carrot. To make this package palatable to the wider labor base, the government is boosting the low-income super tax offset. Currently, if you earn under $37,000, the government rebates up to $500 of the tax paid on your super contributions. Under the new plan, starting July 1st, 2027, the eligible income threshold rises to $45,000, and the maximum rebate jumps to $810. This affects about 1.3 million Australians, 60% of whom are women. The Treasurer estimates this could add an extra $15,000 to the retirement savings of a low-income worker. It's a clever political play, tax the rich to subsidize the lower-income earners. It makes the legislation much harder for the Greens or crossbenchers to block without looking like they don't care about the working class. Reform number 6, the judge's loophole. And finally, reform number 6, the one that always raises an eyebrow. Who is exempt from all these new taxes? Federal and state judges. Yes, you heard that right. Judges' pensions will continue to enjoy their constitutional tax exemptions. Before you get too angry, this isn't just pure nepotism. There are strict constitutional protections in Australia regarding the remuneration of the judiciary to ensure their independence. You can't effectively lower a judge's salary or pension while they are in office, as it could be used to politically pressure them. So, the judges are safe. The rest of us? Not so much. Now, I know what you're thinking. This sounds great, but what about the capital gains tax discount? Excellent question. And this is the giant elephant still standing in the room. The one piece of the puzzle the Treasurer didn't mention explicitly is how capital gains tax discounts will work under this new 2-tier system. Currently, if your super fund holds an asset for more than 12 months, you get a 1/3 discount on the capital gains tax. The rate drops from 15% to 10%. With the new 30% and 40% tax rates, will we still get a discount? Will it be proportional? If they remove the discount for the higher tiers, it fundamentally changes the math on long-term holding. Imagine this scenario. It's late 2025. The legislation is about to kick in. We still don't know if the discount applies. Do you sell your assets before July 1st, 2026 to lock in the current rules? Or do you hold and risk a higher tax bill? This uncertainty is the black box of the current announcement. Until the consultation period is over, we are flying a bit blind on this specific metric. The legislative reality check. Let's tap the brakes for a second. Is this law? No. This is a press release. It's a policy position. It is not legislation yet. The original bill from 2023 has been languishing in Parliament. Why? Because the Senate is a minefield. The Labor government controls the House, but they need the Greens and the crossbenchers in the Senate. The original unrealized gains tax was so toxic that nobody wanted to touch it. With these concessions, specifically the removal of the unrealized gains tax and the sweetener for low-income earners, the path to passing this bill is much smoother. But it's not a done deal. The Treasury will consult until 2026. The bill will likely be reintroduced and debated in the first half of 2026. And remember, Australian politics is a contact sport. Deals are made in backrooms at the 11th hour. While this looks like the final shape of the policy, never say never until the Governor-General signs it. Let's pivot to the human cost. Who actually pays for this? The government loves to trot out the statistic. This only affects 0.5% of Australians. And numerically, they are right. There are about 90,000 people with over $3 million in super, and only about 8,000 super wealthy individuals with over $10 million. It sounds tiny. It sounds irrelevant to the average punter. But if you peel back the layers, the impact is concentrated and severe, particularly for the self-managed super fund sector. These aren't just faceless billionaires. These are small business owners who sold their companies and put the proceeds into super. These are farmers who hold their land in super. I was looking at a report from Class. They're a major software provider for the SMSF industry. Their 2025 benchmark report is fascinating. They estimated that if this tax had come in immediately, just among the funds they administer, the tax bill would be nearly $1 billion. That's an average tax bill of over $51,000 per person affected. Extrapolate that to the whole country, and SMSFs are looking at a $2.7 billion tax hit annually. If asset prices rise by just 10%, which is a decent year in the property market, that tax bill swells to over $3 billion. This isn't just a tax on the top end of town. It's a targeted strike on the SMSF structure itself, which holds a massive chunk of Australia's private wealth. The people most at risk are those in the danger zone, people in their 50s approaching retirement with balances hovering near that $3 million mark. You can't access the money yet to move it out, but your balance is growing into the high tax zone. You're trapped. Also, spare a thought for couples. Let's say a husband and wife have a single SMSF. The wife was a high-flying CEO and has $4 million in her account. The husband has $1 million. The total fund has $5 million. The wife gets hit with the 30% tax on her excess. The husband stays at 15%. But because it's one pooled fund, when the wife has to withdraw cash to pay the tax office, that liquidity comes out of the fund. If the fund is a liquid, say, it owns one big warehouse, managing that cash flow becomes a nightmare that affects both spouses' retirement stability. Okay, enough doom and gloom. We are investors. We don't complain. We adapt. We're the smart money moves emerging from this chaos. The financial advisory industry has been working overtime, and we are seeing 4 distinct strategies rise to the top. Strategy 1, the rise of investment bonds. Investment bonds, or insurance bonds, are having a renaissance. These are tax-paid investment vehicles. The bond issuer pays the tax internally at a rate of 30%. Here's the kicker. If you hold the bond for 10 years, you can withdraw the entire amount, capital and earnings, tax-free. No personal income tax. And crucially, it does not count towards your super balance. Since the original proposal was floated, inflows into investment bonds have surged. Generation Life, a major provider, reported a 57% increase in inflows. Money is fleeing the super system and parking itself in these bonds to keep super balances under the $3 million cap. Strategy 2, the super recycle. This is for those over 60 who can access their super. You withdraw money from your taxable accumulation phase, tax-free withdrawals. Then you give it to a spouse who has a lower balance, or you recontribute it in a way that evens out the accounts. Or you simply move it out of super entirely into a family trust. Strategy 3, the family trust. Speaking of trusts, the discretionary family trust is back in vogue. It offers control and flexibility. You can distribute income to family members with lower tax rates. While it doesn't have the 15% tax rate of super, it doesn't have the rigid rules and caps either. Strategy 4, the charitable route. For the ultra-wealthy, we are seeing a pivot to philanthropy, donating to a private ancillary fund. You get a tax deduction now, you support a cause you care about, and you reduce your taxable asset base. The power couple strategy. But the simplest strategy? It's the spouse equalization. Remember, the $3 million cap is per person not per fund. If I have $5 million and my wife has $1 million, I have a tax problem. But if we can legally shift that so we both have $3 million, we have zero tax problem. Together, a couple can hold $6 million in super at the concessional 15% rate. If you have a large family SMSF with, say, 6 members, kids, parents, you could theoretically shield $18 million from the higher tax rates. The game now is all about balance management. Now, I promise to talk about property. And if you take one thing away from this podcast, let it be this. This policy change is a massive buy signal for a specific sector of the property market. Under the old proposal, taxing unrealized gains, holding property in an SMSF was risky. If the property value doubled, you'd have a massive tax bill with no cash to pay it. Who wants to hold a rental property if you have to sell it to pay the tax on its growth? But that rule is gone. We're back to taxing realized gains only. This means the SMSF is once again a viable, powerful vehicle for property investment. Think about the math. You have a cap of $3 million before the tax rate hikes kick in. This creates a sweet spot. You can comfortably hold 1 or 2 investment properties worth around $800,000 to $1 million each inside your SMSF without ever breaching that high tax threshold. Even if you do breach it, you're only paying 30% on the earnings, which is still better than the top marginal rate of 47% outside of super. So what's going to happen? My prediction, and the prediction of many in the AUS property strategy community, is that we're going to see a flood of money entering the market from SMSFs. They won't be buying $10 million luxury mansions. They will be buying solid, bread-and-butter residential properties. The $700,000 to $1.2 million bracket. Why? Because that fits perfectly into the $3 million cap strategy. If you're a couple with a combined $6 million cap, you could hold a portfolio of 4 or 5 investment properties in your SMSF, pay 15% tax on the rent, and sleep soundly. This is going to put upward pressure on prices in that middle market segment. If you haven't set up an SMSF yet, and you have a balance of around $350,000 or more, which is the general efficiency floor for setup costs, now is the time to sit down with your planner. The regulatory risk that was holding everyone back has just evaporated. The big picture is super safe. As we wrap up, let's get philosophical for a moment. Is your money safe in super? The answer is mostly, but the rules will change. Superannuation is a pot of gold that politicians cannot ignore. It was established in the 90s, and it has been tinkered with by every government since. It is a dynamic system. It reacts to budget deficits, an aging population, and political ideology. When the government needs money, or when the inequality narrative gains traction, super is the easiest target. However, it is also a holy grail of Australian politics. It is the people's money. Changing it is hard. It takes years. Look at how much struggle it took just to get this reform to this stage. So while you should always be aware of legislative risk, don't let it paralyze you. The tax advantages of super, even at 30%, are still world-class compared to almost any other vehicle. Conclusion. So there you have it. The paper tax is dead. A new 30% tier is born, and the start date is pushed to 2026. For the vast majority of you listening, this changes nothing today. But for those building wealth, it clarifies the rules of the game. If you've been sitting on the fence about using your super to buy property, the gate is now open. The liquidity risk is gone. If you're approaching that $3 million mark, you have until July 2026 to restructure, utilize investment bonds, or balance your accounts with your spouse. Don't panic. Plan. The landscape has shifted, but in many ways, it has shifted in our favor, or at least back to sanity. That's it for today's deep dive. I hope this cleared up the confusion around the October 13th announcement. If you enjoyed this breakdown, make sure to hit that subscribe button. We've got more analysis coming on the specific suburbs that might benefit from this new SMSF purchasing power in our next episode. Until then, happy investing, and I'll catch you in the next one.